Hi everyone, this is Handyman for the Everyman. I normally make videos about how to fix things, but today we're going to be talking about a very important topic about house prices in Australia and in fact around the world, but we're going to focus on Australia because that's where I live. Look, I'm going to make the assertion that house prices are actually not rising in Australia. And the one reason that they seem to be rising that nobody seems to talk about in the media. And when I say nobody, I don't mean literally nobody, but if you've been watching the news, if you follow commentators in this space, I don't think this particular point has been made enough. And I think if you understand this, you're in a much better position to know what to do with your money and whether or not you want to be buying property, what to do in terms of if you've got kids and you're trying to give them financial advice, which is what I'm trying to do at the moment. It's really important that if you're an Australian, in fact, if you're living anywhere in the Western world where this is happening, where house prices seem to be rising, you need to understand this concept, which hopefully I can explain to you. So if you can spare 15 minutes to 20 minutes of your time today, I think this is going to change the way you think about property investing forever. Now, this has been the house prices have been a huge political issue, as you know. Last year, I think it was last year, Anthony Albanese was grilled about his $4.3 million house purchase for a while until everybody realized, oh my goodness, like Sydney house prices are, median house price is about $1.4 million anyway. So suddenly $4.3 million for a house doesn't even sound that expensive if you're living in Sydney, although it's obviously very expensive. But the discussion around this whole house price thing has been limited to a few of these points, which when I asked Perplexity, which is artificial intelligence, if you could do the same thing, go into ChatGPT, go into DeepSeek, and you ask the question, why have house prices gone up in Australia in the last 20 years, or at least seemingly gone up in the last 20 years, it will give you these standard sort of 5-point response. And I'm going to go through them quickly because I think you can find out this information yourself pretty easily if you look on the internet, and it's been covered many, many times by other people. But it doesn't cover the one point that I'm trying to make today. The first point that Perplexity says is low interest rates and increased credit availability. So low interest rates is one, and in fact, credit availability is part of the topic which I want to cover today, but I'm going to explain it in more detail. Essentially, it means cheap money. So you've got low interest rates, and that explains half of the equation, and then increased credit availability is one of the main reasons, which it doesn't explicitly explain here, which is kind of annoying because it's actually a really important point. Number two, population growth and migration, which is a political topic at the moment where people are saying, hey, we should stop the immigration. And so that's the demand side of the house prices seemingly going up. Then you've got the supply constraints, the supply side. I won't go through all the details. I think everybody knows. We've got construction costs. We've got labor shortages. We've got, particularly in WA, we've got the mining sector taking a lot of our workers away from real estate. We've got government projects like Metronet, that sort of thing, which actually also take labor away, interestingly. So the government's trying to build infrastructure. It actually takes away from residential building. Economic growth and rising incomes, that's part of the picture. I don't think it's 15%, but that's what Perplexity says. And then government policies and tax incentives, like there's been a lot of media about capital gains tax, about the fact that we've got negative gearing here in Australia. And look, Perplexity says it's about 5% of the equation. Now, I'm not going to get into arguments about that because I think, again, it's a very political issue. But I think a lot of these things are actually distractions to the main issue, which is more to do with credit availability, okay? Now, we've got, so these 5 domains, and it splits it up into different percentages, as you can see on the screen. What this has led to is with these issues, it's led to the house prices going ballistic, as you can see there. And they look very unsustainable, actually. And if you look at the dwelling prices compared to average full-time earnings, you can see there that it's really out of control because you've got dwelling prices going up, seeming in lockstep with average full-time earnings until about 1995. We get to 2000, and that's where we're off. The horses have gone off. And now some people put these down to capital gains tax changes. there was a law that was passed around this time, but there's a lot of other things going on here that led to this boom. And so you can see here that there's a huge disparity between how much you earn and how much you can buy. I don't need to tell you that. It's all over the news. Everybody knows that house prices have gone ballistic, okay? Now, we might be thinking, wait, if house prices have gone ballistic, surely they're going to go backwards so that we can catch up. So if you're sitting there going, well, they've gone they're overpriced, like a share might be overpriced or the ASX 200 might be overpriced. Let's just wait until the prices drop, because surely they would drop. Now, I'm going to say that historically, and look, I've got references throughout the slides if you want to find where these charts come from, so I'm not stealing them, they are referenced. There are a few times in history when there was a drop in the house prices, and World War I was one, Great Depression was one, the credit squeeze, the recession that we had to have, the GFC, and when APRA put in the control mechanisms. Now, even though we call them a drop, the real drops only happened before the 1970s. After that, you can see that the drops haven't been very remarkable. So we call it a drop here, but that's not much of a drop. GFC, you'd think that of all times in history, you'd think the house prices would have dropped badly, but they barely dropped by a few percent those couple of years. And then APRA, when APRA came in heavy-handed with trying to control limit borrowing, then that affected the market as well. But we haven't seen in Australia a massive drop. So if you're waiting for some sort of drop in the housing market, it would really take a black swan event. And even then, with COVID, for example, that was our black swan event, which is not on this graph in the 2020. The house price actually went up. So what's going on, you ask? What is going on? And I was wondering the same thing. What is happening? What is happening? Now, this is a very key chart. I wanted you to remember this chart because later on we're going to reference this. Essentially, house prices change with inflation. So essentially when there's a lot of inflation happening, okay, you can see the annual inflation rate. This is the red line. And whenever the inflation goes up, it seems that house prices go up, okay? Now the thing is, why do you think that is? Now, when we say inflation here, we're talking about the depreciation of money, okay? So money is worth less. And the way we measure it in Australia is we use something called the Consumer Price Index, which, by the way, doesn't count housing in it. So the Consumer Price Index does not count the price of your mortgage, for example. So it doesn't count the asset prices, but it does count the things that you buy. It is an indicator for the value of money that is dropping over time. And as you can see, there seems to be a correlation between inflation. So whenever inflation is high, it seems that house prices do go up. Now, you look at this in the last 20 years, you think, well, actually, the RBA has done a great job at keeping inflation under control, 2 to 3%. But 2 to 3% doesn't count the fact that house prices have gone up. And so your housing costs, the amount of money that you're actually spending either renting or you're buying a house and you have to pay a massive mortgage on it, is not counted in the CPI. So this is a problem with the inflation measure that we use. We say it's 2 to 3%, but it's not. One of the other arguments against the prices going up, you think, well, surely, and this is what I used to think until recently, surely by the time you're getting these ridiculous prices where the average full-time earnings in the cities, so in Perth is probably close to 8 or 9 times your average income here, your median income. So if you're earning, let's say the median income, I don't know what it is exactly now. Let's say to be generous, in a household, it's $100,000. And if your average house in Perth is like $850 now, that's 8.5 times, or 900. It's going to be 9 times the average income. That is massive, okay? And it used to be maybe 3 or 4 times. So you're talking about a ridiculous amount of your percentage of your house. Now you think, well, surely at some point people aren't going to be able to afford to get into the market. That may be true for the first home buyers, but guess what? The first home buyers are just a percentage of the people that own houses. And if you look at this graph, this is a very telling graph. If for those of you that are trying to understand why the house prices keep going up, one of the reasons is that if the house prices go up, right, it actually benefits most Australians. This is Or I wouldn't say most Australians, but a lot of Australians. Most Australians actually don't mind the house prices going up because most Australians own a house. So whenever we're talking about housing affordability, people go, oh, wouldn't it be great if houses were more affordable? But actually, very few people actually want the house prices to drop. Unless you're a first home buyer or you're a kid that's thinking about buying a house one day, you don't actually want the house price to drop because you could end up with negative equity. This is a percentage of people that are owning houses without a mortgage, this blue line here, this dark blue line, and it goes all the way down. It started off at about 42% and it's dropped down, so that was 1994, and it's dropped down to 2020. Okay, so you can see that a huge percentage of people actually own their house outright. They couldn't care less about the house price. They're quite happy for the house price to go up. And if the house price goes up, guess what? They can just move sideways and buy the next house. So if their house is now $2 million, they can go buy another $2 million house. It makes no difference to them if the house price goes up. Now you've got these investors, renter, private landlord, this dark green line, and that's been steadily increasing from about 18% up to 25%. Now these people are owning more of the houses and they are renting it out. So if the house prices go up, those people are happy, all right? They want the house prices to go up. And then you've got this owner with a mortgage. Now these are the quote unquote middle class or working young families, for example, and this percentage has been increasing over time. Now it was 30% in 1994, 95, and now it's close to 36, 37%. These are the people that get affected if the interest rates go up, for example. But again, they're not too worried if their house price goes up because they already own their house. So if you think about it, who's actually worried about their house prices going up is going to be people that want to get into the market. All right. So it's your children. So even if you're a rich person with a very expensive house, you're going to be worried about the next generation because they need to then buy an expensive house. But you can see why with this breakdown that there's not that much political will, even though there's all this buzz on the news. Oh, we're so worried about house prices. Oh, the housing affordability, blah, blah, blah. The majority of Australians want their house prices to go up. The banks want their house prices to go up. The politicians, most of them will own their own houses at least or be investors, they want the house price to go up. So nobody's actually wanting the house prices to go down. Okay. But I've got a much better major point than even this. Okay, so this is a great point, but it's not even the main point. What nobody is talking about is that the true rate of inflation, okay, is about 7% annually. What that means is that, and I'm going to explain to you why. House prices are generally going up about 7% a year. And inflation, true inflation, which includes the assets that we own, everything is going up about 7% a year, roughly. Now, it's not a one-to-one correlation. It's not exactly like that. But I just want to get the principle across, which is really important. And this is the idea of money supply. The money supply is the total amount of money, and there's different measures of it. It's M1, M3. I won't get into the technical details. I'm not an economist, so I don't understand the intricacies of it. You can look it up, but essentially the money supply is the total amount of money that's in the economy at any given one time. The reason why that's important is because if there's more money, it means that money is actually worth less because there's more of it. If there's less money in the economy, the money is worth more. Now, what's happened in Australia? This is the main point I want to make today. From 1990 to 2016, and this is from this Australian money supply article from btclub.com.au. You can look that up. From 1990 to 2016, and again, feel free to double check all the information and put in the comments if the information is a bit off, but I think the general principle is true. Australia has printed $700 billion, marking a 1,644 increase over 26 years, which is an average inflation rate of 7% annually, about 7.2% annually. So the point here in the article that it makes is that your property may have increased over time, but it's at the rate of inflation. So my thesis for today is that the house prices haven't gone up. What's happening is that your money is losing value. Okay? So if property doubles in value every 10 years, so does the money supply. From 2016 to 2024, this is incredible. The entire M1 supply doubled to $1.67 trillion. So it went from 700, it went, they don't have the original number, but it doubled to $1.67 trillion. So it took 40 years to reach 700 billion, and it took 5 years to double it, and then some, increasing it by 2.3 times. Now, the crazy thing is, right, house prices have gone up ridiculously in the last 5 years. Now, this is not a one-to-one correlation. You can't say that it's because the money supply increased by 2.3 times that the house prices went up almost double in that time. That's not the right economic thing to say, but they're definitely related to some extent, because if you increase the money supply, eventually that money that you've given into the economy, that you've printed out of thin air, that money has to go somewhere. And eventually it gets into the hands of richer people who then, they don't spend all their money. They're not going to then have 5 haircuts a week. They're not going to necessarily buy five more cars. If they have extra money, they're going to invest it into real estate in Australia. Not only that, but there's also the effect of they can then borrow more money, even more money, to then buy even more property. So that is one of the mechanisms. I'll explain a little bit more about how money supply impacts the house prices, but that is one mechanism. So here's a graph of the money supply. This is M3, which is the total money supply. And you can see, it doesn't really matter which one you're looking at because they're both going up at an exponential rate. You can see the money supply here in grey has been increasing like this in Australia. And then you can see that I've superimposed the residential property price graph on top of this one. And as you can see from here, 2004, the residential property prices have been going up in this exponential rate, whereas wages have been going like this. Now, again, I'm not saying that these are one-to-one correlated, but they're definitely contributing to the house prices going up. And the real point I want to make today is, because this M3 is going up and your house prices are going up pretty much at the same rate, essentially your house price is not actually going up if you measure it in actual tangible assets. Now, one way to think about this is house prices as it relates to gold, because gold has got a limited supply in the world. And so I'm going to show you a graph which comes from a website here that you can click on that to read it in more detail. But this website is actually to do with gold, by the way, buying gold. And I'm not advocating buying gold, but I think the point is really important here, which is that gold prices have been going up. And the reason gold prices have been going up, it's not because gold has suddenly become more valuable. It's because the denomination that we measure gold in, i.e. Australian dollar, has been going down. So what that means is, if you spent $100 on gold years ago, it is now worth, let's say you spent, let's just pick a point here. So 1970s, you've got, let's say it's about, I don't know, like 7,000 as an index. And now, oh my goodness, from 1970 to now, it's gone from 7,000 index to 100,000 index. Okay, what's that, like 10, 15 times? It's gone up 15 times from there to there, okay? Now you think, wow, gold has gone up in value. It hasn't gone up in value. Gold is the same. Gold is gold. Like a 1 kilogram gold is the same, 1 kilogram gold as it is now. I mean, you might mine a bit more gold, but essentially, if we use gold as sort of like the gold standard, quite literally, it means that money has actually been dropping in value over this time, right? I mean, you can mine more gold. I don't understand the ins and outs exactly of how gold works, but essentially the point is it's got a limited supply of gold. And yes, you can mine more gold, but there's still a limited amount of gold. So there's a certain limit to the amount of gold that's in the world. Whereas with money, you can print, the governments can literally make money out of nowhere. So they can basically devalue. They can make your money worth less without even asking you about it. The governments don't ask permission to do this. The RBA just does it. It's not even part of the legislation. They can actually just go, okay, we think we need to print more money, and so increase the money supply, and then they just do it. So essentially your money can get eroded away, and it has been. And as you can see, look, let's take Perth as an example. That's the green line here. It doesn't really matter which line you look at. They're all the same. They're all going up like this, like exponentially going up, because every year they're going up. And I don't know whether it's exactly 7%, but it's going to be roughly there. So I'm going to say it's roughly 7%. Feel free to correct me if I'm wrong. But house prices are going about 7%, gold is going about 7%. And essentially all that means is money is going down 7% every year. In other words, if you earn $100,000 today, next year you're earning $93,000. The year after that, you're earning, I don't know, 86,500, something like that. And every year that goes by, you're earning less and less because your wage prices aren't going up 2 or 3% every year, which is why 30 years ago you could work any sort of 9-to-5 job and you could afford to buy a house. You could just go and buy a house after a couple of years maybe of saving for a deposit. Now you can earn a very high income, seemingly high income, and you can't afford to buy a villa like in Sydney. You can't afford. You could be a doctor in Sydney and you can't afford to live anywhere near the city, and you're earning, I don't know, whatever you're earning, you're hundreds of thousands of dollars, and you still can't afford to buy a house in Sydney. So is it that the house prices have gone up, or is it that you're just earning less? And my argument would be, if you use absolute dollars, if we just pegged, let's say, pick a date, 1970 or 1980 dollars, right? And let's just say you took into account inflation and you just kept everything else indexed at 100. If everything else stayed the same, all that's happening is that you're earning less and less. You're earning less and less as time goes by. And the house prices stay the same, but you're just earning less and less. And everything else is just going up in price, seemingly, but it's not. So ask Perplexity again, if you increase the money supply, how does it actually increase house prices? What's the link? And I won't go into all the details here. And it's to do with interest rates, but it's not exactly just to do with interest rates, because interest rates are complicated. Because obviously the banks can set the interest rates whatever they want. So there's a lot more in terms of like the actual price of money in the market. But yes, generally speaking, if you increase the money supply, you're going to lower interest rates. And that's one of the ways that they use to lower interest rates, by the way. So the two are not separate issues. So lower interest rates and monetary expansion are linked. Obviously, increase borrowing capacity. So people can borrow more if there's more money. There's inflation of asset prices. Now, I was actually asking how it increases the asset. So this was number 3 is actually how. How does it do that? It just says that it leads to asset price inflation, including real estate. Investors may view property as a hedge against inflation, which is what we talked about before, because literally hedging against inflation, further driving demand and pushing prices upwards. Now, as I've said, we're not even hedging against inflation. We're just trying to hold on to something. Well, it is hedging against inflation, but you're not beating inflation. You're actually just holding a property that's just holding on for dear life to the value that you bought it at in the first place. I won't go through all the points there, but essentially the point here is that increasing money supply does seemingly increase house prices. And then I said, why didn't you even talk about monetary expansion in the original answer? Like, this kind of like a big point. And then it said, well, it's because, look at this. The omission likely occurred to focusing on more commonly discussed factors, okay? More commonly discussed factors, things like immigration. Everyone's like banging on about immigration. Everyone's talking about negative gearing. Everyone's talking about supply, and there's not enough supply, there's not enough. All those things are true, but at the core, there's a structural issue that's much bigger than immigration. It's much bigger than some of the demand supply things, which will change over time, because yes, eventually we're going to build more houses. But the point is, the monetary expansion has played a crucial role in driving up house prices, especially in recent years. You doubled the money supply in 8 years. You've doubled the money supply. Of course, it's going to affect house prices. And so these are things we talked about. Increased liquidity pushes downward pressure on interest rates, leads to asset price inflation. Again, this is the point here. It increases asset price inflation, right? And when I asked the AI, I said, look, what are the chances that monetary supply is going to contract in the next 10 to 20 years? It basically said, it's not going to. It's very unlikely to. And why is that? Again, I'm not an economist. Somebody else can answer it much more eloquently than I can. But the bottom line is, the government keeps borrowing money, and we're in this society. We're in this financial system that's all debt fueled. So essentially, they're going to just keep printing money. That's just what's happened. And when something bad happens, like COVID or something else happens again, the war happens, and then the economy is going badly. What are they going to do? They're going to print money again. All right. So this is just going to keep happening, and historically that's what's been happening. Is that essentially the money supply is going up 7% every year, and that's at a minimum. And it actually escalated in the last 8 years. Okay. So then I asked AI to then break down the percentages and just talk about monetary expansion as a separate heading. And what it did was it said low interest rate at 30. Again, these two are linked, but they're not the same thing. But low interest rates was 30%, and then it put monetary expansion at 25%. Okay? Now, how is it that we don't talk about monetary expansion in the mainstream media? Why is this issue not even talked about? It's not even brought up as a political issue. It reminds me of the American politics where, like, one of the most obvious things in America is that the government just owes too much money, right? They do talk about it, but the answers, anyway, I won't go there. But anyway, but the point here is everybody, we were talking about, house prices are going up, blah, 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 and then we're banging on about government policies, which, I gave it a second chance to talk about it again and put it down to 10%, supplies 15%, population growth at 20%. But monetary expansion, which is linked to low interest rates, by the way, these two factors, which are all to do with credit and the amount of money that's in the system, all right, is ranked at 55%. Now, even if AI is completely wrong, it's going to be, I think it's going to, somebody can correct me if I'm wrong, but it's going to be about half. So in other words, half of the reason why your house prices in Australia are so high is because you've got too much money in the system. Now, that is actually a controllable factor. You can actually control for that. You don't have to have that much money in the system. But because we live in this structure, it's going to keep happening. So the house prices on paper are going to keep going up. Now, again, the thesis of this point that I'm trying to make today is that your house prices are staying exactly the same. But inflation is a lot higher than anyone would admit to. The true inflation rate is going at about 7%. So every year that goes by, you're losing 7% of your income. Okay. Now in 2013, I found this article from actuaries.asn. Now this, if you don't know what actuary is, these super clever people, very good at maths, and they basically calculate things and try to predict the future based on the mathematics of it. And what they've said is, in 1971, and these numbers are a bit different from the previous article, so I don't want to get too stuck into the detail, but the main point remains. So it says here, basically, M3 from 1971 until now has increased 88.9 times, okay? Multiples, a lot. In the 5 years, M3 rose by $532 billion, okay? Over the past 20 years, it says here that in the last 20 years, the money supply has increased by 9.6%. CPI has only increased by 2.7%. So in other words, money supply has been going close to 10%. And the other article said about 7%, maybe over a longer period of time. But regardless, money supply is increasing at a very high rate. So money is essentially becoming worth less and less. In the article, it says that the recurrence of periods of booms, which followed by periods of depression, is the unavoidable outcomes of attempts repeated again and again to lower the gross market of interest by means of credit expansion. There is no means of avoiding the final collapse of a boom, it's very negative, brought about by credit expansion. So basically, this actuary is arguing that essentially this can't keep going on because eventually everything will collapse. A final collapse of the paper money system involves the public losing faith in the value of money. The demand for money collapses. Those holding nominal assets, such as government bonds, suffer large losses in real terms. So this is one argument to say it's actually a good idea to own some property. Okay, so basically they said actuaries should be aware the current government fiat system is unsound. And the Australian, oh hold on, did they say Australian or Austrian company? Oh, okay, wait a minute. No, this is Australian. Surely it meant Australian. Was that a typo? I'm gonna have to look this up. This should really say Australian. Not the Austrian economy. The Australian economy is facing a final and total catastrophe. Doesn't really matter whether you're Austrian or Australian because I think the same point applies. Anyway, in summary, house prices are rising, but they're not really rising. Okay, house prices are not rising in real terms. That's what really the point here. One takeaway from this is that the middle class, just normal people, working people, you're going to need a property. You need to have property to prevent ongoing deterioration in your income. Now, one other issue with this is that if money is devaluing and your house price is not actually going up, if you then take an interest, if you take a loan that is less than 7%, let's say you take a loan that's like 6.5%, and you're paying that interest to the bank, and let's say your house price goes up 7%, you're not losing money just because you're paying the interest. Because as long as the interest rates are not too high, your debt is actually getting worth less and less as time goes by because money is devaluing. So as long as the interest rate is not really, really high, then you're actually still winning, even if you borrowed money to buy that property, okay? Now you need to do the calculations and the differential between the true inflation rate and the interest rate. But essentially the point is that for a lot, especially if you're investing in a property, if you invest in a property and you get some rental yield, you're going to beat the inflation rate, okay? Well, you're definitely going to beat CPI rate, and you're hopefully going to match the true inflation rate, even if you're paying the interest, okay? If you follow what I'm saying. In other words, debt over time, if money is devaluing, it also means that if you borrowed $1 million today, in 10 years' time, that $1 million debt is actually worth a lot less in 10 years' time. Let's say that in true terms, it's worth 7% less every year. In 10 years, that $1 million loan is actually worth $500,000, okay? If you follow that logic. As long as the financial system as it stands continues, asset prices, including real estate, will continue to quote unquote inflate. At some point, theoretically, this financial system may collapse and money could one day become almost worthless. But guess what? You're still going to need to live in a house. So you can take away what you will from this little talk today. But it kind of completely shifted my mind when I started to understand, wait a minute, money supply is actually increasing. Inflation rate is actually closer to 7%. That blew my mind because it means that if you're relying on your income alone to generate enough money in the long term, or you're hoping that, your kids can get a good job, sorry, why am I doing this? Can get it's a fake job, no. Can get a job that can then, sustain them without ever investing in property or buying their own property. It's not going to work because wages do not go up at 7% every year. That just doesn't happen. Nobody's going to pay you 7% every year, which literally means that everybody is just getting poorer. And the housing price is placing more and more people in a situation where they can't afford a house anymore. And so you can take away what you will. My takeaway from that is that it's important that young people try to get into the market as quickly as possible. Even if they have to borrow money, again, please seek your own financial advice. This is not financial advice. I mean, no, I can't give you any financial advice at all. But my own personal takeaway would be, I'd be leaning towards trying to get a property as soon as possible, whilst you can still get into the market. Because as you can see, the structural factors are there that will just keep this thing going probably in the medium to long term. At some point, the house of cards may fall, but again, you're still going to need somewhere to live. All right, thanks everyone. Hopefully that was helpful, and until next time.